So let's say you're a successful business owner.
I'm a billionaire!
You've had a great year, and you're looking at a $10 million tax bill. That is money that is effectively gone, handed over to the IRS, never to be seen again. But then your accountant mentions a specific section of the US tax code, and suddenly, instead of writing a check to the government, you're shopping for a Gulfstream. And here's the kicker. By the time you're done, the government has essentially subsidized the entire purchase. You've acquired a $20 million asset, and it cost you almost nothing in net cash flow. This is the world of bonus depreciation, and it's the reason why, if you try to buy a private jet in the month of December, you'll find it's the busiest shopping season on Earth. Not for toys, but for tail numbers. Most people see a private jet and think luxury. They think about the champagne, the leather seats, and the ability to skip the TSA line at O'Hare. But billionaires don't look at jets as planes. They look at them as giant, flying tax shields. To understand how a $50 million jet becomes free, we have to stop looking at the wings and start looking at the math. First, we need to understand how the government views stuff. Normally, if you buy a piece of equipment for your business, let's say a delivery van, you can't just deduct the whole cost from your taxes on day one. If the van costs $50,000, the IRS says that van is going to last you, say, 5 years. So they make you depreciate it. You deduct $10,000 this year, $10,000 next year, and so on. It's a slow burn. But in the world of private aviation, the rules are different. Under a provision known as Section 168K, or bonus depreciation, the government allows businesses to write off a massive percentage of the purchase price of an aircraft in the very first year. For a long time, that number was 100%. Right now, it's 80%, heading down towards 60% as the law phases out. But the impact is still staggering. Let's run the numbers because this is where the free part comes in. Imagine a billionaire.
I'm a billionaire!
Let's call him Mark. Mark's company made $100 million in profit this year. In the highest tax bracket, Mark is looking at a federal tax bill of roughly $37 million. That's cash leaving his pocket. Instead, Mark buys a pre-owned Bombardier Global 6000 for $25 million. Because he uses it for business, he applies 80% bonus depreciation. That means he gets an immediate tax deduction of $20 million. That $20 million deduction lowers his taxable income from $100 million down to $80 million. By spending that $25 million on a jet, he just saved himself $7.4 million in taxes he would have paid anyway. But it doesn't stop there. He now owns an asset that holds its value remarkably well. He has traded tax money, which is gone forever, for equity in a jet. When you factor in the financing, the interest deductions, and the tax savings, the net cost of the jet starts to look like zero. In some specific scenarios, the tax savings actually exceed the down payment on the loan. The government is quite literally paying you to fly private. And this is the part most people don't think about: the December rush. If you walk onto the tarmac at Teterboro or Van Nuys in late December, it is chaos. Why? Because to get that tax break, the plane doesn't just have to be bought, it has to be placed in service. You have to fly at least one legitimate business mission before the clock strikes midnight on December 31st. We are talking about billionaires racing against the calendar, flying a 45-minute leg just to prove the plane is operational, all to secure a $10 million tax save. But why does the government do this? Is it just a gift to the ultra-wealthy? The official reason is economic stimulus. The idea is that if you encourage rich people and corporations to buy jets, you're supporting the thousands of jobs at Boeing, Gulfstream, and Cessna. You're supporting the mechanics, the pilots, and the fuel providers. It's the trickle-down theory at 40,000 feet. Whether it works for the economy is debated, but for the billionaires, the math is settled. Now, let's talk about the catch. Because in the airline business, as we know, the costs stack up fast. Buying the jet is just the entry fee. To keep that free jet running, you are entering a world of eye-watering operating expenses. A typical heavy jet, like a Gulfstream G650, costs about $5,000 to $8,000 per hour, just to keep in the air. Fuel is the monster under the bed. A G650 burns about 450 to 500 gallons of Jet A per hour. At $6 a gallon, you're looking at $3,000 every single hour just for the gas. If you fly from New York to London, a 7-hour flight, That's $21,000 in fuel alone. Then there are the people. You can't fly these things alone. You need 2 highly rated pilots. A senior captain for a G650 can easily command a salary of $250,000 to $300,000 a year. You need a flight attendant, another $100,000. You need a director of maintenance. And then there's the hangar rash. Just parking the plane costs money. A hangar in a prime location like Aspen or Miami can cost $5,000 to $10,000 a month. Even when the plane is sitting still, it's eating. Insurance is another $50,000 a year. Subscriptions for the avionics and flight maps, $30,000 a year. So how does the billionaire justify this? If the jet costs $3 million a year to run, how is it still free? This is where the charter offset strategy comes in. Most of these owners don't just let the plane sit when they aren't using it. They put the plane on a Part 135 certificate. This allows a management company to rent the plane out to other people when the owner is at home. If Mark, our billionaire, only flies 100 hours a year, but the plane is chartered for another 300 hours at $15,000 an hour, the plane starts generating millions in revenue. That revenue covers the pilots, the fuel, and the maintenance. Now look at the full picture. You bought the jet using money you would have otherwise lost to taxes. You used bonus depreciation to wipe out your tax bill for the year. You charter the plane out to cover its own operating costs. At the end of 5 years, you have flown 500 hours for free, and you still own a jet that you can sell for $15 million. You have essentially conjured $15 million out of thin air by using the tax code as a lever. But here is where most people realize the game is rigged. To make this work, you have to follow the 51% rule. To get the tax break, the plane must be used for business more than 50% of the time. If Mark flies to Vegas for a weekend party, that's personal use. If he flies to Vegas to meet a client and then stays for the party, that's business use. This creates a massive gray area that the IRS spends years trying to police. It's why you'll see private jets landing in the Caymans or the south of France for board meetings. As long as there is a documented business purpose, the flight, and the entire cost of the jet remains tax deductible. It gets even deeper when you look at how these jets are financed. A billionaire doesn't walk into a dealership with a suitcase of cash. They use asset-based lending. They take a loan against their stock, say their Tesla or Amazon shares, at a 3% or 4% interest rate. They use that cheap debt to buy the jet. Since they aren't selling their stock to buy the plane, they don't trigger capital gains taxes. They are using debt to buy an asset, using that asset to delete their income tax, and using charter revenue to pay off the debt. It is a closed-loop system of wealth preservation that the average person sitting in 32B on a Southwest flight can't even fathom. But what happens when the party ends? The biggest risk in this free jet model is recapture. If you sell the jet, the IRS wants their money back. If you wrote off $20 million on day one and then sell the plane for $15 million 3 years later, the IRS treats that $15 million as ordinary income. You're hit with a massive tax bill the year you sell. So, what do billionaires do? They 1031 exchange. Or they did until the laws changed. Now, they use a strategy called like-kind, or they simply keep the plane until it's worth very little, or they buy a bigger plane to create a bigger deduction that offsets the recapture of the first one. It's a treadmill of acquisition. You keep buying bigger and better jets to keep the tax bill at zero. This is why the private jet market is currently seeing record-breaking demand, even as prices for new Gulfstreams hit $75 million. When you add it all up, the bonus depreciation, the interest deductions, the charter revenue, and the equity retention, you realize that for the ultra-wealthy, a private jet isn't a cost. It's a strategic financial tool. The person flying 40,000 feet above them in a Global 7500 isn't paying for a seat. They are playing a completely different game. They aren't looking for a flight. They are looking for a way to keep their money away from the government. In the end, the jet isn't free because it doesn't cost money. It's free because it costs less than the alternative, which is paying your fair share of taxes. So next time you see a sleek white jet climbing into the sky, don't just think about the luxury inside. Think about the tax code that built it. Because in the world of the 1%, the best way to make money fly is to make sure the IRS never sees it land. If you want to see how this same logic applies to super yachts, where the math is even crazier and the loopholes are even wider, let us know. That's a whole other story.